There's money here everywhere. I mean, the junked food in the UK, properly digested, would generate about 2% of our electricity. It's a staggering sort of number. Everywhere there's opportunity there.
Ernst & Young estimates that by 2020, some £100 billion of renewable energy asset infrastructure investment will be required in the UK alone, and in excess of $1 trillion will be required across Europe.
Renewables offers institutional investors something that they're very much wanting. It does provide long-term inflation-linked cash flows, and that is something that a number of our clients are after and are struggling to find in this environment.
We need new investors, we need the industry to provide the conduits of capital to allow LPs like the London Pension Fund Authority to invest in teams with absolute expertise.
Too many investors want it all done. They want it built out, operating, up and running, ribbon attached. And there seems to me to be a shortage of capital or risk capital at that stage, which historically perhaps the construction companies would take, or the banks perhaps mispricing risk would take as well.
It needs political spike first. If the politicians believe there's votes in actually driving towards sorting out waste, things might happen a bit quicker. Failing that, the current regulatory, legislative environment that we have mean that things will take place at a very low speed indeed, and will continue to. Inefficient, expensive, slow, not achieving very much.
I believe we're now getting into a different paradigm where we're getting much more interest. We've had institutionals do direct debt. We've got institutionals, things like Aviva providing money directly to Drax, not buying Drax shares, lending money. I think we're really seeing a much greater maturity on the LP institutionals and family offices and everything than we saw before.
We expect the UK to have to invest somewhere close to £200 billion to hit its 2020 goals. About £110 billion of that is in generating assets. The rest is in energy efficiency and in supporting infrastructure, grids, ports, that type of stuff. If you think that'll happen, let's say over the next 10 years, because the mathematics is easier for me, that's about 20 billion a year. And at the moment, we're investing about 8 to 10 billion per annum. So we're investing at about 40 to 50% of that which is necessary.
We've been talking a lot about ESG today, and I think I cannot stress it enough how important it is for us because of our responsibility towards our investors and the community at large. So definitely ESG, good principles. And also, countries need to have the right regulations in place so that we as investors can come in a safe environment, really.
I'd like to see some really competent management teams put together with large-scale projects. I think the greatest problem we've found as an investor is really, enthusiastic amateurs rather than professionals. And so I'd like to see some teams with, long-established energy professionals, whatever sector we may be talking about, who actually know how to operate a power plant, rather than people who think it's a good idea.
Today, the drivers are resource and energy efficiency. We have seen in the past period how price of metals went through the roof, how access to certain rare earth metals has become a big issue. So how you see developments in China, in Beijing, if you have been there recently, you can't live there. Pollution. So these are real problems that will require, that are creating significant opportunities.
Green technology has actually become more of a sector focus focused on resource efficiency. So be it energy or water or use of bio-based material, and they're all flowing into different industry sectors. And there's a lot of activity happening, and there's corporate interest and consumer interest in adoption of sustainable solutions.
When we started back in 2000, I think our first fund was primarily focused on energy generation. A lot of those industries have actually matured. PV is a perfect example. Wind is another example. I think there's still a room for us to play in those, but it's more like new materials to improve efficiency on PV, perhaps some novel technologies on wind services. But really the focus of the fund goes much more into materials technologies and also the convergence of IT and clean tech.
What is the value add of the manager? You have to dig deeper than the numbers. I think the numbers is important, of course. At the end, we have to deliver to you LPs the numbers. That's why you invest in us. But you also have to dig how do they achieve these numbers, and can they reproduce it with the next fund, or was it a one-shot wonder?
A lot of the LPs were a little bit disappointed about some of the returns of the exits. So I think they're getting much more cautious on their GP relationship, and they're going to invest in second funds only if they really see that they've done something different than the industry, something that brings a lot of value to the company.
We're still very interested in investing through funds. It's just that funds should, in our view, try to align themselves more with who we are. I mean, we're investing for pension funds, so we have liabilities over 25 years. So if we're investing in a fund with a lifetime of about 7 to 10 years, it just really doesn't match our liabilities. So I think that funds should try to put themselves in our shoes and try to structure the funds differently. So why not start a 20, 25-year life fund?
A lot of the GPs that we saw initially were fairly inexperienced, so they tended to come out of this from either a financial background or an industrial background. And one of the things that we would like to see are GPs that have a real mix of a technical background, have the industrial network, but also understand what's investable and what's not investable from a finance point of view.
Explaining more the value in previous deals, in previous portfolios, not just so much relying on figures and net asset values as getting the message across, but explaining the value creation better in terms of what has been created, what value has been created in the portfolio, and getting this message better across.
We're looking for a degree of capital growth as well as income. We're looking for managers who have built well diversified portfolios and have competence to invest across asset areas by both sector and by geography, and a consistency of performance which we expect to see replicated in new funds that we're making commitments to. So at the pre-construction stage, the predictability of yield is less important and the potential for capital growth is more important.
The really good thing about this is that you have a real diversity of backgrounds. So you've obviously got people from a GP perspective, LPs, but also a number of corporate investors as well. And I think from our perspective, it's really useful to understand that whole ecosystem and see what other people are thinking and share views.
The attraction of this event is you don't actually have LPs and GPs get together very often. You don't have them get too often without hundreds of other people. So I think that's, to me, the particular attraction of this event.
Oh, I think it's a great event. I mean, you get one day in London, everybody that you want to talk to for the next 3 months or so in a place. So it's of great help, of course.
So we've got about 100 LPs and GPs mixing in the room. We've heard a lot of good presentations about what particular sectors and assets parties will be focusing on. And I think that just helps to bring a lot of the innovation and the creativity, having them centered in one room and coming up with ideas on what they're going to do for 2013 and beyond.
I think it's really great. I mean, about 2/3 of our work is doing the deals and the due diligence, but I think these events give us the opportunity to meet informally with people, bring about new relationships, which then lead to fruitful transactions in the future. So really good.
It's very useful for us always to interact with our clients, both from the GP side, to find out what they are doing, what positions they're taking in the market in order to help bring them the right opportunities from the developer side, and indeed to meet investors that are looking to put large amounts of capital to work in a very important industry.
Well, since we're here in the UK, you've got to recognize that the UK has established the Green Investment Bank, and that's specifically to invest in offshore wind amongst other asset classes. But offshore wind is going to be a strategic focus for them. I think that's an enormous statement by the government and a real, let's say, putting your money where your mouth is, in having the seed capital of £3 billion to invest in offshore and some other asset classes, and also to really be including other financial investors into the spectrum, along with a green investment bank, is a huge statement by the UK in their, let's say, indicator of how they feel about the offshore wind technology.
If you put a lot of money into subsidies, then most of the money, especially in Europe, is going to Chinese companies. So you're not really helping the local economy. You're maybe changing a little bit the level of less climate change. But the Israeli government has said, okay, let's see what is the really best thing in Israel that can help boosting the thing, and that's really innovation. By really boosting innovation in the country, then you can actually develop new technology that you can then sell all over the place, and not just use in the specific place where you get the subsidy.
UK, we are, we're in the middle of, a sea change, which was meant to encourage, but at the moment is discouraging, and we will see what's going to happen. Ireland has actually done quite well, surprisingly, considering they are pretty much bust, but they've actually got people coming back. But that's because the resource is very good and they're very proximate to here. Germany remains the most stable, but the returns. You talk to someone like one of the big Munich houses, and they look at solar as effectively a high-priced German Bund.
Obviously, the government has been hugely supportive of the industry to date. The cases of much debated, much talked about retroactive cuts to feed-in tariffs are very few and far between. However, they have been done, and that obviously increases investor nervousness. Having said which, if a government can't afford to support renewable energy or the myriad of other industries that are taking place within that country, then I think we have to expect cuts. It's an affordability issue.
I think the problem with it is you've got massive uncertainty over the subsidy regimes. Whatever the government say, you just don't believe it. And so, certainly we, from our perspective, are almost assuming there is no subsidy. And if you assume there's no subsidy, does the project stack on its own right? So, in many ways, if government actually got out of the way completely, we get on a lot faster.